you have too much debt, there's a number of different things you can do to resolve that situation. And exactly the same as what you can do to resolve a situation, so the government can also take a similar action if it has too much debt. The first thing you could do is to reduce your spending. So rather than going out and eating at nice restaurants, you can stay at home and eat bread and water. Cancel those exotic holidays and go camping for a couple of weeks. And exactly the same way, a government can embark on austerity. They can reduce government expenditure. The second option open to you is to get a pay rise, maybe get a second job, earn a bit more money, go and see your boss, ask for a pay rise. And the same that a government can do that through tax rises. They can increase the taxation in order to pay down that debt. You could work hard, get a promotion, work your way up through the organization and ultimately become a fat cat or an overpaid CEO of a multinational. And then the same option is open to a government. They could grow their economy and grow their way out of debt. If you think about it, if you have a worker on a low wage and they have $1 million mortgage, that's a bit of an issue. But if you have a CEO on a multi-million-dollar pay package, then their $1 million mortgage is less of an issue. And the final option to you is obviously to default. You just say, I'm really sorry, I can't pay my debts. And the same option is open to countries. They shouldn't really be doing this, but for example, Argentina does have a history of defaulting on its debt. Now, in terms of a country, there's a fifth option. Now, you and I can't do this, okay? So if we try this option, if we're caught trying it, we will go to jail. But as a country, as a government, you can, and it is, of course, to print more money. And by printing more money, you create inflation. And in effect, you inflate away your debts. So as we've discussed before, if you print more money, it creates inflation. Inflation debases the value of the currency, and therefore the value of the debt relative in that currency effectively goes down and goes away. However, before we embark on a process of inflation and printing money, we need to be careful that we understand the implications of inflation. And this is best summed up by John Maynard Keynes, who in 1919 said, by continuing a process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. So in effect, if you have $100 sitting in your bank account and it's been sitting there for a very long time, the purchasing power of that $100 has been reducing every single day. In effect, the government has been confiscating your wealth secretly and unobserved. Sounds good. But John Maynard Keynes goes on to say, by this method, they not only confiscate, but they confiscate arbitrarily. And while the process impoverishes many, it actually enriches some. Those to whom the system bring windfalls become profiteers, who are the object of the hatred. The process of wealth degenerates into a gamble and a lottery. Lenin was certainly right, he explains. There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency. The process engages all of the hidden forces of economic law on the side of destruction, and does it in a manner which not one man in a million is able to diagnose. And I think that's a really interesting quote, because if you think about the extra $23 trillion that has been created by the central banks since 2007 in response to the global financial crisis, in response to the pandemic, and actually in the intervening period, you can start to think, well, what's the effect? It hasn't been inflation in terms of commodity prices, but that money has to go somewhere. And where's it gone? It's gone into asset prices. It's gone into real estate. It's gone into stock markets. It's gone into bond markets. So who are the people who benefit? Well, the people who benefit are the people who own those assets, the rich. And the people who don't benefit are the people who do not own the assets, the poor. And so what we see is, as a result of this extra money printing, the wealth inequality, which has been getting increasingly unequal since about the early 1990s, 1980s, is actually accelerating. The rich are getting richer and the poor are getting poorer. And if you start to feel that, it's very difficult to put your finger on it, but whether it's the Arab Spring in 2010, whether it's the Catalan separatist movement in the 2015-2016, whether it's the French Yellow Vest movement in 2018, or the storming of the US Capitol in 2021, you kind of get a sense that populist movements, while not directly linked to money printing, my personal belief is that the money printing that has been undertaken by the central banks is certainly lending fuel to that fire and having an indirect impact in the increase in populism that we've seen in the world around us. And if we're not careful with inflation, then inflation can get out of control. Now, you may remember we talked about the debt of the United States, and we concluded that the debt of the United States at the time of recording this was about $27.6 trillion, 27.6 trillion of these. But I, unbeknownst to you, can repay the debt of the United States today. And I can repay the United States today nearly 4 times over, because I have one of these, and this is effectively the result of hyperinflation. This is a $100 trillion bill issued by the Central Bank of Zimbabwe. And where did the Bank of Zimbabwe get the money from? They just printed it. They printed the money and they gave it to the Zimbabwean government. Now, when we think about it, that's quite interesting. So if you think about these two bills, we've got a dollar bill and a $100 trillion bill. Which do you think has the greatest purchasing power? Well, of course, you'd be right. It's the dollar bill. This actually has no purchasing power at all. It has a value as a souvenir, as an interesting artifact, effectively. And you can pick them up in markets and souks around the world. So let's look at the lessons from Zimbabwe in hyperinflation. In 2006, the inflation rate was estimated at 100,000%. By July 2008, that had increased to 2.2 million%. In August of the same year, it was 11.2 million%, and by October, it had reached 231 million%. According to Wikipedia, by the end, the interest rate was estimated to be 6.5 quintillion novemdecillion, effectively meaning that prices doubled every single day or every 1.3 days. Now that's incredible. That means that this can of Coke, if I buy it today for $1, tomorrow it's going to cost me $2. And then the day after that, it's going to cost me $4. And then 8, and then 16, 32, 64, 128, 256. You kind of think, hold on a sec, by this time next week, it's going to cost me $256. And it's going to continue to increase. That's just crazy. And if you want to know what it's like to live in that kind of environment, a friend of mine said that he used to live in Zimbabwe and he used to play golf on a Saturday morning with his friends. Nothing wrong with that. He said we'd turn up, we'd play 9 holes, we'd have a drink, we'd play another 9 holes. And he said things got so bad that they would turn up in the morning, and before they teed off, they would order their drinks and pay for them, because by the time they'd played 9 holes, the prices of those drinks had gone up. And you suddenly think that you can't live in an economy like that. And so if you remember our equation that says that if you increase the money supply and the velocity stays constant, then the prices will go up because the quantity has to stay constant. But if you increase the money supply and the velocity starts to increase, so this is effectively, if somebody pays you a Zimbabwean dollar, you need to get rid of it as quickly as possible. You can't wait until after the 9th hole to buy the drinks. You have to buy them before you tee off, and the quantity stays constant. Therefore, the price starts to go up exponentially, and that is where inflation turns into hyperinflation. And lessons in hyperinflation not only limited to Zimbabwe, we can go back in history to the Weimar Republic in Germany. So to pay for the debts of the First World War, Germany taken to the Treaty of Versailles and told they had to pay all of those debts, all the reparations. Now Germany, having just fought a war, had lots and lots of debt. And they said, we can't afford it. And John Maynard Keynes says, we shouldn't really be making them do that. But the rest of Europe said, no, we've got to make sure that Germany learns its lesson, and effectively made Germany pay for those debts. Well, Germany said, we don't have the money, but we do have a printing press. And you could stand on the cobbles of the Bundesbank and you could listen to the rumbling of the printing machines in the vaults, and you could hear them printing the money day in and day out, night and day, 24/7. And it created inflation, and it created hyperinflation. And we had people like this gentleman who was pushing the wheelbarrow of his money down the street, and if he was robbed, people would take the wheelbarrow, tip the money out, and they'd steal the wheelbarrow because the wheelbarrow was worth more than the money. It led to the death of the Weimar Republic, a power vacuum, and we all know what happened next. And Germany, as a result, is very, very nervous of hyperinflation. Today, hyperinflation exists in one of the richest countries in the world. Venezuela, in terms of its natural resources, is one of the richest countries in the world, and yet their economy is a basket case. If you go to Venezuela, they don't count your money, they weigh it. Okay, and this is the result of hyperinflation. So hyperinflation, inflation and hyperinflation, is a little bit like toothpaste. It's very easy to get out of the tube. It's a little bit more difficult to get back in again. And in order to control inflation, the central banks use interest rates. And the last time the US experienced high levels of inflation was back in the early 1970s in the oil price shocks. And in response to that, the chair of the Federal Reserve at the time, that's Paul Volcker, he raised interest rates from 10 to 20% in 1 year to combat runaway inflation. Now think what your life would be like if interest rates suddenly had to go up to 20%.